Hi everyone. Lately I've been talking a lot of new operators and landlords through the concept of economies of scale when it comes to running a co-working business or a flex space, and how that plays out when you're looking at how much space you need to allocate to this business, right? And I think it's really important also for the landlords specifically to understand this, because then they have a bit of a better understanding and a reality check on the feasibility and the profitability that a co-working business or a flex business can experience if you only allocate a small amount of area to it. So what I've actually done is I've looked at 3 scenarios here that I've brought up in a very simplified spreadsheet of a 2,000 square meter, 1,500 square meter, and a 1,000 square meter flex business, right? And each of these scenarios are relatively the same in terms of product mix. It's more to demonstrate where and why these economies of scales occur. Why is a 2,000 square meter business much more profitable than a 1,500 and 1,000? Well, we're going to get into that today. And if you've got any questions and you want to go into this into even more detail, please feel free to reach out. So if we start at the 2,000 square meter one on the left-hand side of this spreadsheet, you'll notice that I've estimated around 280 desks. That's about a desk density of 7, meaning if you divide the 2,000 by 280, you're going to get 7, right? In the past, you would have seen co-working operators and business hit a desk density of as low as 4.5 to 5, especially in certain markets in Asia. However, in a post-COVID world and where experience is now ruling, much more spaciousness around these workstations are important. So 7 is a pretty, realistic and conservative density to use if you're running a feasibility across a certain net lettable area that you're looking at. Because, not only does it accommodate for that extra, that additional expectation for more spaciousness around the workstations now, it's great when you're running feasibilities because you're going to run into problems with the floor plan that you look like likely, where there's certain corners or areas that aren't exactly usable. There might be, extra large columns for structural purposes within the layout, or the facade may be designed in a way that you can't actually build up to the facade. So the 7 density accommodates for a bit of that, because over the last, I'd say, 6 projects we've designed, we've built, and we've delivered, we're getting very much closer to the desk density of 7 to 8. Right? I think the worlds of the 6 and below are kind of gone. So use 7. And then if you can go denser without sacrificing the experience and amenities, then you can do it, okay? And you'll notice that before I even get into the numbers, you could still probably achieve a 7 with a 1,500 square meter NLA. However, when you start getting smaller to the 1,000 square meters and below, you've got less and less space to allocate to those commercial workstations and desks and everything, because the amenity areas you still want to put in those co-working spaces and flex spaces still need to retain a certain amount of area to be a good experience. You can't just keep shrinking the lounge areas or the kitchenettes or wherever you want someone to be able to do something just because the area is getting smaller. There's a certain expectation to those amenities as well. So if we stick to the 2,000 square meter one and we go down, I've used an average occupancy in year 1 of 58%. Basically, that just means in any feasibility or co-working business, you want to start at around the 20-30% day 1. So you pre-market the space so it's at least that full so it can cover costs. Plus, it's really hard to sell a flex or a co-working space if it's empty, right? You want some form of buzz and community there. And it takes 12 months to hit an 85% occupancy. So your average for that year is 58%. And then year 2 onwards, you're going to be at 85% occupancy and beyond, right? You don't really model for higher than 85 unless it's for sensitivity analysis, because it accommodates the fluctuations in a flex business. So if we look now into revenue and operating costs and all these things that'll help tell the story of why economies of scale are important and occur. In hindsight and retrospect, we actually don't need to look at year 1. We're just going to focus on year 2 because let's say the business is humming after a year. So from year 2, your total revenue in a 2,000 square meter space is circa 2.4 million, okay, in this scenario. And that's where you've got 280 desks, right? You may have maybe 5 or 6 meeting rooms in an event space in this scenario too. So majority of that income comes from the desks, and rightfully so, because in a world of flexibility, the most reliable source of income are those private offices and suites, which you can license and sell out 12 months plus at a time. I actually find the enterprise style client, which is now developed in a co-working world, actually want their office spaces longer than 6 to 12 months. They're starting to do 24 to up to 36 month deals, which is great because it helps underpin your flex revenue, right? Also not so great because if they take up quite a bit of space as an anchor customer, you'll be sweating bullets when their license is coming up to an expiry because you'll be wanting to do everything to retain them, right? So rightfully so, majority of it is in desks. In terms of that desk split of office to open plan, in this 2,000 square meter scenario with 280, I'd say maybe like 240, 250 of them are in the offices, right? And then you've got maybe 40 of them in the open plan workstations where it's used more as a design consideration to help the floor plan breathe in certain areas and open it up. And those dedicated desks are more if, office purchasers, when they have guests, would like them to kind of bleed out into the open plan desks and workstations. The ratio used to be a lot more like you'd see floor plans where it was 140 in desks and 140 in open plan, because the thought process was the open plan desks were attracting a certain demographic that would grow, buy an open plan desk for a month, then buy 5, then 6, and then as the team grows, then move into an office. But that feeding psychology just didn't play out, right? So that's why you're starting to see, especially in a very enterprise flex-dominated world, much more private and serviced office than open plan desks. Your meeting room and events, you've got here at 225K. Again, I would say this is for a 1 12 to 16 person boardroom, maybe a 1 8P to 10P and 2 4 to 6Ps, maybe a podcast studio there. That much revenue attached to meeting rooms might scare some operators, even though it's got an event space in there, because they're used to packaging it up into the desk package. So if you look at that and it kind of, you raise an eyebrow, it's really just semantics. You move that money around. The 2.1 million of the desks in this scenario would be larger because you charge more for your desk because you're packaging in those meeting room credits and free meeting room spaces and everything. That being said, I feel like leniency, relying purely on desk income, even though it's the thing that's underpinning your P&L, we're now starting to need to see more omni-channels of revenue by operators. What can you do differently to help diversify some of that income to spread that risk as well? And then miscellaneous, this is like your virtual office, your concierge, whatever you can think of kind of goes in there. Existing brands that have large networks and established brands can milk that miscellaneous line item quite a bit, right? And in some cases, it's what actually is a very fat revenue source in that P&L that makes certain sites that shouldn't work, right? But that's not something that you could really lean on if you're a landlord trying to do something for your own asset for the first time, or you're a new operator. So stick to the desk and meeting room income and see what you can do in the miscellaneous. Now, before I get into operating costs, when you look at the 2,000, the 1,500 and the 1,000, you'll notice that the revenue significantly decreases. Well, because you're largely reducing the number of desks that you can sell, right? So the revenue is decreasing. However, and I'll break down the operational costs in the first scenario first, you'll notice that the operational costs don't really change too much. Why is that, you say? And this is where the economies of scale argument comes in. To run a co-working business, there's a certain expectation of how that is run and what that experience is, from on-site staff to community engagement activities to partnerships to all those kind of things, to the technology, the app, the network effect. I'm not saying that every flex business P&L needs to look like this. This is just an example to demonstrate to you what a traditional scenario looks like. I actually think we're entering a market where the P&Ls could evolve to include spec suite leasing fees, because maybe you might only, even in this 2,000 square meter scenario, maybe only 1,000 of it is traditional co-working and the other 1,000 is larger spec suites of 25 to 50 desks that you're actually leasing to the market and taking a fee for. Well, then that looks a bit different, right? And you can maybe shave off some of those operational fees because you manage the expectation up front with those customers that a lot of it's largely self-service. But I won't go down that tangent. Now, when we look at this 802K, it's broken up into property, flex operational, and overheads. Obviously, there's a lot more detail that goes into this, but for the purpose of this video, we'll keep it simple. The property costs are at 120K because that's your cleaning, your utilities, your electricity, your repair and maintenance, all that kind of stuff, which is pegged to the NLA of the space. More space, more expensive. The flex operational cost, that's kind of like your what are you doing every week from a community and activations perspective? Where's your budget there? What's your incidentals for members? And the expensive one is, what's your network and connectivity? What back-end platform are you using? That kind of stuff, right? That's that cost. Now, overheads, the largest number is your on-site staff and your annual marketing, your accounting, your legal, all that kind of thing. The reason why it looks the same for each scenario is I'm a big believer that a single staffed site is set up for failure, right? Unless it's integrated into the building management team, right? Because that person's going to get lonely, the person's going to get bored, and they're going to turn over. And in a co-working and flex business where retention is more important than signing on customers, you want your staff to be happy. I feel like many operators out there are too focused on their customer experience, which is important, but not focused enough on their staff experience. Because if your staff keeps turning over, well, then your customer experience is going to suck and your retention is going to go down anyway. So I always like to try and I learned this the hard way through my amazing operational team, 2 people, right? Unless there's some sort of hack where they feel part of a building family, or there's other teams within the asset that you're also responsible for. Like, for example, from a JLL perspective, even though we run the flex, if we also manage the property and it's big enough where we've got property asset managers in there under our umbrella, then maybe we can figure something out, right? Because our flex team can talk to them and work with them. So you'll notice if you compare each of the scenarios, the 3, the 2,000, the 1,500, the 1,000, in the costs, it really is the only real difference is the property fees, and that's because the size is getting smaller, right? Everything else kind of stays the same. Again, that being said, this is a generalization in terms of a video of how you can see economies in scale and why traditional operators need that 2,000. But I'm seeing more and more scenarios of the 1,000 square meter flex and co-working sites and smaller, where the operator's doing creative things and operational jujitsu to bring those costs down. Where, what's very common in the hotel world is if you've got a big hotel, one of your brands, and then some of these smaller runs around it, you can borrow staff from one another, right? So very likely, if you're a co-working operator and you've got like one fat HQ site and maybe 2 or 3 small ones around, there's probably a scenario where you can borrow from resources from the large site, right? Which is a plus. I won't go into outgoings and rent hurdles. I think that's for another video. You've got your operator fee here, which is around 8% of rev. So it's interesting to see, though, how it decreases the smaller the site you get, right? Even when you look at the profit share that goes to the operator, from a 2,000 square meter site where you're earning circa 300 plus K per annum if it's doing well, down to 120K for a 1,000 square meter site. The next question then comes as the operator, is it worth your time? I would argue running that 1,000 square meter site is going to be just as much as a headache as the 2,000. So where's the reward, right? And that's a big reason why, as an operator, you really have to think, if you're going down the traditional model, what's the right amount of space, okay? And then as an owner, similarly, if you look at the total income to the owner at the bottom, even though you've got the 1.3 mil for the 2,000 and maybe the 1 mil and the 470, it's important to look at it per square meter, like across the NLA, right? Because that's how, as a landlord, they want to rentalize the number and not just look at the income. You've got 671 per square meter, which in this particular market is good. For the 2,000, then you've got 637 for the 1,500 and then dips down to 470. So you can kind of see the economies of scale really kicks in where you're not going too below the market expectation of how much money you should be making from that site, around the 1,500 square meters and just below it. As long as the operator's okay with a smaller fee, right? There's lots of different moving parts here. Real economies of scale happen, the 2,000 square meter plus, because there's a certain point where even a 2,500 square meter site, you may only need 2.5 people to run it, but then you're fitting in more desks, more income, and the costs aren't hockey stick growing like the revenue. That's a big reason why you've seen many legacy co-working sites go up to 5,000, 6,000 square meters, right? Because it's really a game of greed after the 2,000, 3,000 square meter site if you think you can fill it, which is more difficult, excuse me, in this current market. Personally, for me, the 1,500 square meters is, I think, appetizingly right-sized, where you could fill the site, do really well, and then if there's aspirations to grow beyond it, then it's a conversation with the asset owner to do that. So hopefully this video was helpful. If you'd like to discuss it in more detail, please let me know. If you're an operator, I implore you to think about the 1,500 square meter size. I just think the future of co-working and flex, the big spaces are gone. And if you've got the gumption to go for it, you almost need to be this really cool gangster brand that only has a handful of sites and not a large world domination brand where, you know, a big site dipping to 60% occupancy, even for a quarter or two, is very meek. You know, it's not good. Like, because the 1,500 as well, these forecasts are 85%. You've got a higher chance of hitting 100%, you know, of those. And then the numbers look even better. Okay, I'll stop there. So hopefully that was helpful. And please let me know in the comments if you'd like to see more of these style videos where I kind of break down a P&L and go into more detail. And please reach out if you'd like to have a chat. So thanks for listening.